Hello and welcome to another episode of Macro Mondays. This episode is being recorded on Friday the 8th of November. I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
And I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
As with every week, we will be bringing you some of our key market data, charts and risk. We'll be analysing the major geopolitical event over the past week, the US election, and we'll also be discussing some of the key central bank meetings over the previous week and the week to come.
We'll be highlighting some of the key weaknesses we've been observing across the euro area, as well as looking at the China stimulus package announced today. We'll then wrap up with the week ahead in data.
Yeah, so as a brief menu and what to look forward to for this episode, I mean, it's been a very volatile week in markets for a number of reasons, US politics being one of them. We'll be discussing initially the Trump victory that proved far more convincing than many polls had been predicting. The Fed and the Bank of England have both decided to cut by 25 bips as expected. We're going to be analysing what the movements are going to be in the weeks to come. Are we in for a period of easing to come?
And it's been a bumpy ride for sovereign debt markets this week, with yields initially rising on Trump but then falling on Fed. So we're going to be looking at the equity reaction as well, and then going around to Europe, which still appears to be stuck in a bit of a rut. We'll then be looking at whether the China stimulus is going to suffice and will actually lead to a recovery over in China.
Yeah, so there's clearly a lot to break down over the past week, but I think there's no better place to start with. In London, it was Tuesday night, Wednesday morning's news of another Trump presidency. He becomes only the second president to have two non-consecutive terms, the last one being in 1897, I believe. So this is, really quite a coup for him and his party. And it was far more convincing a presidential campaign than many had suspected, wasn't it?
Yeah, well, I mean, polls running right up until the final votes were counted were painting quite a neck-and-neck picture. If you looked at the betting odds, they weren't, but as we discussed last week, you need to take those with a pinch of salt. But in the end, they proved a little bit more representative of the result we got in the end.
Yeah, absolutely. I think it's very hard for people like us in our position to be able to call this election accurately because, yes, the betting odds were clearly favouring Trump. But I think it's quite clear to all that betting odds have a skew. It largely appeals to a male demographic, etc., etc. So whilst in betting odds people are putting their money where their mouth is, and in polls people have nothing at stake. So in some ways you ought to have a closer correlation. There is this skew, which I think is an important caveat that people did consider and should consider. But nonetheless, a lot of this polling data, it's not purely surface level, and you had people like Nate Silver doing quite advanced polling analysis, but not coming up with the right answer on this one.
Yeah, I think a lot of it is a sampling bias. If especially on the Republican side, you have a lot of quiet Republicans who might be a bit shy to give their response in a survey or in a poll. So then you see the Republican vote being underrepresented in those polls.
Yeah, I think another thing to note with polling data is that a lot of these polls their conclusions were things are neck and neck. And what you typically have in these polls is they are not self-referencing to their own poll, but they will look at the data from other polls. And if they see their results as an extreme outlier, they disregard their results. So what you have is this statistical herding, which in statistics, it's a serious problem with data and polling like that. But yeah, overall, decisive victory, and it looks as though Trump is going to have control over both the House and the Senate, isn't he?
Yeah, it's looking likely that he'll have kind of the triple stack. The House is looking closer and closer to be called Republican. But there's still a lot of congressional races still to be counted. So he's not quite over the hurdle there yet, but it's looking like it will be that way.
Yeah, and with this, there was an immediate reaction. If we look, well, let's first talk about the yield curves.
Yeah, so finally we got a bit of a market-based inflation expectation reaction. 5-year break-evens jumped about 14 basis points, but we had, a rally in yields fully down the curve, and that was, that was the first instance we've really seen of market-based inflation expectations driving the rally in yields that started in September. Since then, yields have come off a little bit. They peaked at 447, but now they're back around 430 following the Fed cut.
Yeah, I mean, the headline we've got there is Trump perceived to be inflationary. And I think that's clearly what the market is expecting. Number one, people are expecting, relatively solid economic performance. Equities, as we'll come to discuss, reacted well to this. But, inflation is going to be inherent if you have someone talking about tariffs and protectionist trade policy. So that does seem to be what the market saw this as.
Yeah, for sure. And I think there's other drivers there as well. So that his immigration policy as well is perceived to be inflationary. There's been a lot of people try and estimate what it's going to mean, but I think the headline is that no one really knows. That I've seen ranges from 9% plus to it's only going to hit inflation by maybe 1%.
Yeah,
and that is still based off of assumptions of say 60% tariffs on China, 10% tariffs on the rest of the world. If he can't manage to pass that, then we'll probably see less. And with anything, these tariffs, they're a bargaining chip. Whether he will actually come and enforce such aggressive tariffs is yet to be seen. So yeah.
Yeah, and then just to talk about equities briefly, I think it's fair to say that the equities in the US in particular responded very well to this news. S&P rallied 3.3% since the election. Nasdaq up 4.5%.
Yep.
It sounds as though a lot of people see this as a decent buying opportunity, and maybe we're going to be moving into a continued period of support for equities that have already done well, but I suppose people are expecting this to continue.
Yeah. I think a big thing is going to be the deregulation. Trump is hoping to really cut back on red tape that came in under the Biden administration, and equity markets. Yeah, they responded really well to that, as we can see.
Yeah, I think the graph we just had up there was the Tesla price, which whilst being representative of a tech stock in the US and a company with big market cap, I think it's worth noting that obviously, this is Musk's company, and it sounds as though Musk is going to have a non-insignificant role in the Trump administration in years to come. So no surprise that Tesla stock gapped up on news of Trump's victory. And then, just to talk about oil quickly, because obviously energy and energy policy has been one of the big headline drivers in Trump's campaign. And we've seen a very mixed reaction in the oil sector to Trump's election. So flat price perhaps defied the drill baby drill rhetoric. We didn't see an immediate sell-off in Brent that you can point to. It's been quite choppy. There have been upticks as much as there have been downticks. And I think there are a few reasons that we can explain this. First and foremost, drill baby drill and increasing things like fracking. Yes, fantastic. That's going to put more crude on the world scene. That should have a deflationary price impact on the world of oil. This, of course, is not how it simply works. The US isn't the only oil producing company. You were immediately met with OPEC announcing, or might have even announced slightly before, that they are going to continue their cuts. So it sort of has checks and balances. This is a global commodity, and whilst Trump might want to max out drilling and production of the raw crude, you're going to be seeing a plethora of price impacts there. You have to consider his foreign policy, especially with regard to Iran. So if we're going to be entering a period with tariffs on China, that's going to affect US-Chinese trade balances. And if he's going to be putting sanctions on Iranian crude, etc.,
potentially Venezuela as well.
Exactly. These countries have quite good routes now. Venezuela perhaps less so. Iran most certainly has a fantastic outlet in its oil to China. So if you're saying that Trump's going to sanction Iranian oil, and he's also going to put tariffs on China, it's not going to necessarily reduce the flow of oil onto the market there. So you're having a very mixed picture, and it's all quite muddied on a crude basis.
Yeah, and one thing that I find quite interesting looking at this chart as well is the reaction during Asian trading sessions and European sessions versus during the US session. So you can see there, after about 12:30 UK time, there's a strong bullish reaction. Both days captured in the chart. Do you think this is just kind of risk on? US is happy about the election, equities are doing well, so why not buy oil as well?
Yeah, I can see that holding a lot of truth, to be honest. You have people want to put crude of some description within their portfolio. It's a good thing to own. It has different inflation expectations to equities, etc. So people quite often, fund managers, etc., will, I think, be quite happy to buy on that news. You also have to think about the positioning of people coming into the election. And it sounds as though we get the feeling that quite a lot of people had pre-positioned for a Trump victory. So the headline news of Trump comes in, drill baby drill, prices come off. I think quite a few people had put a fair amount of money into that. And so it almost becomes a bit of a crowded trade in that sense. And so when it becomes crowded like that, I think you're very vulnerable. So a bit of buying can stop some of these shorts out, and then you see these price spikes, then it goes in its cycles. So we're seeing a very cyclical pattern here.
And obviously the demand picture in crude markets more broadly is pretty muddy at the moment. People aren't really sure whether China's doing well, whether it's going to make a recovery, what's going to happen there. Europe's doing pretty bad, and then the US seems to have engineered a soft landing. So it's where do you price oil demand? Where do you see that as well? And obviously, will Trump tariffs lead to dampened economic growth globally? Who knows?
Yeah, I think there's a whole lot more that we could unpack here, but in the interest of time, we'll probably move on. But yeah, if you want to just speak briefly about the Trump impact on green deals and the environment.
Yeah, so that was quite a dramatic move. Obviously, here we have Sunrun equities falling following Trump's victory. No surprise really. One of his championed policies will be to cut the IRA, the Inflation Reduction Act, including the Green New Deal that Biden brought in. So yeah, we've seen a pretty dramatic repricing of these renewable stocks.
Yeah, and we're going into COP29 this year, and there are quite a few leading figures on the global scene that are missing from this. So notably US, i.e., the soon-to-be President Trump not there, Modi not there, Xi Jinping not there, France and Germany's representatives missing. So from a green perspective, perhaps we're going to be going in the direction that everyone thought, and this period of less environmental regulation, I think we're going to be deepening our exploration of that, and to tie in with obviously the oil industry. It's clear to almost everyone what the environmental impact of fossil fuels are, etc., etc. But you actually do see some muddied price effects as well because of some renewable legislation that's already in there. So if we were to look at the US gasoline industry, RBOB, we've actually seen prices of rubbers, the US gasoline sort of strength measure against crude. We've seen that rallying, and this is because of these things called RINs, Renewable Identification Numbers. And RINs have been rallying because of bean oil differentials, i.e., soybeans. Soybeans have been rising because of tariffs. So what we're seeing is, despite rhetoric saying we're going to flood the market, we're going to max out production, because of things like tariffs, you have these offsets because everything's so interconnected. So boycotting things like green deals has an impact, but it's not to say that that's going to completely change the market, because you have dependencies upon so many other markets on an international scale. So yeah, I think that just speaks to how interconnected everything is here.
Yeah, definitely.
And then back to sort of the portfolio of our imaginary fund manager. Nvidia had quite a good week.
So Nvidia knocked Apple off the top spot, at the same time replaces Intel in the Dow. So after Intel's disastrous earnings, they reported a $16.6 billion quarterly loss, and their share price has tumbled 50% this year. Nvidia has since been added in their place. So, yeah.
I mean, it's been a huge driver of the S&P's growth overall, hasn't it? So I don't think it's necessarily too much of a surprise that it's been added to the Dow Jones. But and then let's talk about uncertainty. So there's still a good amount of uncertainty left in the market, but in terms of volatility, we've seen a slight convergence post-result.
Yeah, interesting, because if you read about the election, the one thing that people emphasize is that Trump is unpredictable, and we don't really know where his policy will take us. But markets seem to have reacted differently, with the VIX really retreating. Similarly, when we saw corporate spreads contracting, it seems like the market is not really pricing risk.
Yeah. Well, perhaps they've just got their Twitter algorithms that follow Trump's tweets. They've got that infrastructure already in place from the last 10. But no, it's... I think this is probably a sign that a lot of people didn't know how to call it because of things like very tight polling data. So even if there's Trump uncertainty, overall, I think a lot of people have a better sense of what policy in 2027 is going to look like now than they did 3 weeks ago. I think just because we have a result, and these two campaigns were obviously so far away from each other in all sorts of things, but especially things like fiscal policy. And moving on from fiscal policy, let's now talk about monetary policy. So Jerome Powell is still sitting in his chair, and he had a busy week as well. Much as Trump says
otherwise, show up to work once a month apparently.
Powell,
he reiterated he would serve his full term when the FOMC cut rates by 25 bips. It was widely expected by markets. It was almost fully priced in the OIS. But the interesting move really has been the flattening of the OIS curve. So although markets are pricing fairly consistent cuts, the rate of easing is starting to slow in the OIS.
And why do you think that is?
Well, Trump tariffs. I think inflation expectations have jumped. So the Fed doesn't have as much room to cut, and that terminal rate at the end of the easing cycle is most likely going to have to be higher. At the same time, the Fed's not really in any rush. We had one rough NFP print, but that was largely driven by idiosyncratic factors like the strikes at Boeing, which have now finished,
the hurricane,
etc. So I think that the Fed and the broader market really look past that print. But the future path of rates, only 14 bips price next meeting. What do you think about that?
Yeah, it makes entire sense, right? If people are pricing in such high inflation, you've got yields, strong. The Fed, with its dual mandate of controlling inflation and helping out on unemployment, it's going to now start to have to worry about inflation more so under Trump than it would have done under Harris. So the sort of the limits of their decreasing they can't really decrease as willingly now as they would have been able to, had a Harris government come in. But I think also the thing that's worth noting here is Powell suggested this 25 bip cut based on labour market conditions. He said it's eased rather than slowed. I think that's just rhetoric there. I mean, labour market conditions have eased, as the non-farm payroll data suggested. But it will be interesting to see what unemployment does over the next sort of 2-4 years with tariffs, because tariffs can actually be a relatively positive thing for domestic employment if you have industry domestically flourishing under those tariff regimes. It can be at the cost of all sorts of things like competitiveness, but it's one of those where we might flip back from this worry of unemployment to pure inflationary, and you might see actually a bit of a decrease in rates followed by an increase over time. And I mean it's a tough one to call, really. We've seen quite a aggressive appreciation in yields, right? Yields have shot up. That is restrictive. So if there is tariff-driven inflation, then if we see a dramatic tightening in credit conditions, that could also offset growth. So it could go both ways. It's a really tough one to call, and we hope that Trump will be able to balance that line. Indeed, and he, I think, obviously is not necessarily too pleased with the Fed's independence, but it remains an independent body, and he will exert as much pressure as he can, I'm sure, but that won't necessarily guarantee that Powell and the Fed go in and do exactly whatever he says. But moving on as well, the Bank of England cut rates by 25 bips as well. Yet again, totally unsurprising. So this was following the UK budget that came out, Rachel Reeves's budget last week, as we discussed. But what are your thoughts on the Bank of England cut?
So it was a much more unanimous decision this time than the previous cut. It was 8-1, with Catherine Mann being the only member voting to keep rates stable. It makes sense to start to continue the easing cycle. Really, inflation's on its way down, and especially with Trump on the horizon, adverse effects on Europe could pass through to weaker demand in the UK. So making sure we're ready for that. But then they were still conscious. Trade disruptions could play an inflationary role. So definitely one to watch out for.
I think. I feel like we're saying it over and over again in this episode, but it's very mixed, right? Because unemployment is rising a bit in the UK. It's not at fantastic levels. And it sounds as though Europe is people are really worrying in the EU about what a Trump presidency will mean for European productivity. I'm not sure that the special relationship is necessarily going to hold up over the years to come. It doesn't sound as though Trump is the biggest Starmer fan or vice versa. So I wouldn't be surprised if the UK is brushed with the same stroke as Europe, if not treated as its own independent case and subject to similar trade restrictions. So yes, that may have a inflationary price impact on goods imported, etc., etc. But if you can try and jump the gun a bit and be proactive with your monetary policy and really try and hopefully breathe some life into UK business, then perhaps you're going to be able to get out in front of it. But, so now on to the euro area, as we're referencing week after week, it seems like a horrible picture.
Yeah.
If we're looking at the data, and whilst it might be nice for a holiday, I'm not sure that the longevity of European manufacturing or political certainty is going to be guaranteed.
Yeah, for sure. I mean, well, we had Scholz calling for a vote of no confidence in January, setting the stage for a snap election, really, as the German government disintegrates. It's really looking messy on a political side there, as well as just the macroeconomic side.
Yeah.
So on the more macroeconomic side, exports fell 1.7% month on month in September, worse than expectations of minus 1.4%. And that's reversing August's 1.2% increase. And this is particularly concerning, as we'll talk about later. You know, this is the time that the US really should be front-loading those European imports.
Yeah.
And that's what we saw in the Chinese data, ahead of trying to kind of beat Trump tariffs. So the fact that we're not seeing that front-loading even in September the picture's looking pretty bad there. And that passed through to industrial production, which fell 2.5% month on month, again below consensus of a 1% fall. That puts it 4.6% down year on year.
Yeah.
It's really, really bad.
Yeah, and one of the other bits of data is the euro area retail sales growth. This slowed in September to 0.5% month on month, down from August 1.1% increase. So, yeah, it's flogging a dead horse at this point. But we're not seeing fantastic data out of a lot of the euro area, especially Germany. And I think seeing political uncertainty and the potential of a snap election in Germany in the very early parts of 2025 is no surprise. I think people are worried, people are unhappy. So yeah, we'll see what we see there, but expectations should be tempered.
Yeah, and I mean another thing is that 20% of Europe's exports are destined for the US. They have a big trade surplus with the US. So with Trump potentially smacking 10% plus duties on those exports, people were concerned. And we saw that in capital flows over the election. So yields, we saw a huge inflow, a bull steepener across the core euro curves. The 2-year bund fell almost 14 bips. And it's safe haven flow, it looks like. People exiting equity positions and buying bonds, especially those shorter tenor bonds.
Yeah, and just to sort of bring it back a tiny bit to trade flows, it's going to be interesting to see what the moves are going to be on the euro dollar over the next few months, especially because obviously there's been an appreciation of the dollar. We've been seeing the euro dollar falling. So I think we might well see, it could get to a stage where you start to see exports and things like yields, even if we see it pass through, they could improve again from Europe to the US, but this could be an FX effect. So it's going to be interesting to bear the FX story into all of this
for sure.
when considering it over the next few months.
And I mean, the dollar has been, in my view at least, a little pretty skewed by the Trump trade, and we've started to see it come off a little bit now as people start to take profit or exit those positions. Same story with the treasuries. People have started to buy back their shorts a little bit. There's been a bit of caution there. But yeah, it'll be interesting to see how the dollar evolves from a kind of a trade principles perspective as well.
Agreed. And then we've been talking about tariffs for half the episode. The country primarily in question for these tariffs, China. They've had some more data come out over the past week. What's the news and what's the situation there?
Yeah, so broadly speaking, the data coming out of China has been a bit more positive. We've seen the City Economic Surprise Index actually flip back into positivity for the first time since June. And China CAC services PMIs printed at 52, beating expectations and accelerating expansion from last month's 50.3. But the big story has been exports, surging 12.7% in October.
Back up.
And that's probably front loading. It's hard really to explain that otherwise, with the rest of the world economy really looking poor, especially in Europe. But yeah, the CSI 300 has responded positively, up 3%, and the Hang Seng is up 1.9%. So yeah, things are starting to look better. But one thing you've got to remember, especially with the economic surprise index, is which is moving relative to the other. Are we actually seeing consecutive strong prints? Because 52 for services PMIs is good, but it's not exceptional by historical standards.
Yeah.
Or are people's expectations actually just being revised lower?
Yeah, absolutely. And with any data that is sort of rolling over time, you see these averages move down and move up, and so it can be easy to overstate any successes, and it can be easy to over dramatize any shortcomings. What you try and look for is sustained data on whether it be a month by month, sometimes quarterly by quarterly, perhaps even longer term if you can't trust the quarterly data. And so whilst a 12.1% surge in exports sounds fantastic, like amazing, as you say, front loading contextualizes that. Poor exports over the previous 9 months contextualizes that. So this is without doubt, if accurate data, positive data, but contextualizing it doesn't necessarily change your view on the Chinese economy, may not encourage you to take out a long-term sort of dollar-yen position, etc. So yeah, I think those are very much things to consider. But looking forward, we're going to be seeing some more intervention from Chinese authorities into the domestic market.
Yeah, so we've seen another fiscal injection announced. They've announced a 10 trillion yuan fiscal package for local government debt refinancing. So there's been a key kind of financial stability vulnerability within local government debt. There are these highly leveraged local government financing vehicles, and a lot of hidden debt that was looking pretty bad, especially as it was used for a lot of infrastructure projects, which then struggled to actually make a return and then struggled to finance themselves. So what China are proposing on doing is raising the debt ceiling for local governments to 35.5 trillion. And this was well received. 10-year local government yields fell to the lowest since the start of September. But really the measures kind of fell short of what a lot of people were wanting, which was targeting the consumer. Yeah. And the Chinese consumer really isn't going to get much from this.
Yeah, we saw it with the previous bazooka, as it yet again was referred to. An initial uptick and positive reaction, but the pass-through rate of intervention like this to, number one, to institutions, number two, to consumers, it just sort of gets siphoned off more and more, as is almost inevitable. But when you hear, some of the Chinese banks looking for some of this money to be used to sort of increase their sort of stores of, essentially improve their liquidity, reduce their risk of default, that of course means that this cash cannot be re-injected into the economy.
Exactly.
Perhaps doesn't go to consumers, perhaps doesn't go to the real estate sector, which they're so desperate to keep alive. But yeah, I mean, overall, it seems to be having an impact. It remains to be seen whether you're going to be seeing such an inflight of Chinese money into, gold, which was seemingly that was the trade that really carried gold as well as central bank buying for much of the previous quarter.
Yeah, I mean, it's also very difficult with China because, as I discussed last episode, their savings rate is about 50%. So in good times, and we're not currently in good times, so it's probably higher than that. In the US, it's more like 18%. So if you do provide stimulus to the consumer, even then half of it's dumped into savings. So it's a tough one for the CCP and the PBOC.
Yeah, and I think, on things like savings rates and that discussion, let's look at the central bank OIS pricing for the next 12 months. So I'll just run through these quickly. The Fed, we're now forecasting 84 bips. This is off the back, as we've discussed, of the Trump presidency and increasing inflation expectations. And the ECB, I believe they have their meeting next week, and they're forecasting a 25 bip cut there.
Yeah.
So we're now seeing that as 133 basis points over the next 12 months.
The Bank of England is expected to cut 64 bips over the next 12 months, and the RBNZ is expected to cut 132 bips.
Yeah, and then Australia and Canada continuing cuts, and BOJ still remaining positive. And then now let's just move on to the key data that we'll be looking at for the next week. So coming up on Saturday, we get the Chinese inflation rate. We get the PPI data there. Then on Tuesday, we get UK employment data, Euro area ZEW economic sentiment, and the US NFIB business optimism index. We also get India. We get their industrial production, we get their inflation rates, and we get their manufacturing data.
Then on Wednesday, we get the US CPI inflation, and as well as China total social financing. On Thursday, we'll get the UK's Q3 GDP preliminary estimate, as well as Euro area employment preliminary and industrial production alongside their second GDP estimate. We'll also get US PPI data.
And then, to round up the week, next Friday, we get Chinese industrial production, Chinese retail sales, fixed asset investment, and also their unemployment data. We get Japanese industrial production, and then we'll be having US retail sales and US industrial production data coming out. So another busy week of data. Perhaps we're not going to be seeing quite as much volatility as we have this week, given hopefully a bit more consensus on US politics, etc. But crucially, in the world of commodities, we're still going to be looking at headlines as foreign policy in the Middle East looks to play out. So there's still everything to play for. So I think we'll round up there, and thank you very much for watching.